So in corporate finance, if we talk about, for example, how to increase the shareholder wealth, and when in corporate finance, companies pay taxes, so how to manage the tax consideration. Sometimes the corporations work, and sometimes financial management is very necessary field, because the companies must know where to invest and where to save money and where not to make the unnecessary changes. So there where corporate finance comes, and where to invest capital, what kind of capital should be spent on R&D and other departments of corporation. So corporate finance and understanding of corporate finance is very important. So let's dive in to know more about it. Moving further, what is corporate finance? If you see here that corporate finance have many major roles in building up of a corporation. For example, how to raise finance in the company, because big corporations need money for their operational activities, for other activities as well. So corporations need money. So even the projects which are very influential, sometimes the idea is very influential, but the persons who have idea do not have money, and sometimes the investors do have money but don't have the idea, or do not have the time to run the business, so they invest into someone's business and get the dividend paid out of that. So where to invest the finance, how to monitor the finance, and how to plan the finance for long-term obligations, for long-term investments, for long-term profits. Okay, so this is all what corporate finance is comprised of. So moving further, if you will see here, so here you can see that how the projects are comprised with different kind of people. For example, people with ideas but not enough money are the companies. Okay, they invest in projects through their ideas. Okay, the people with money but no ideas are the investors, so they give money to the companies and companies invest in the projects. So this whole management is called financial management or corporate finance. So key takeaways from corporate finance is that how business fund their operations in order to maximize the profit and minimize the cost. Okay, how they run their day-to-day operations via cash flows, and how they invest for the future flourishment of the business. Okay, how they prepare their financial statement, how they pay taxes, everything which is considered into this field is called corporate finance. So what is a stock? Stock is a very famous and very common factor which is used and which is being referred again and again. So what is a stock? A stock is a security, is a financial security, is a portion, is a ownership, or it's a portion of ownership which belongs to a corporation. So for example, the owner of a stock has some proportion of ownership over the company's assets and the profits, and equal to how much stock they have in the company. So it's a proportion of a pizza. For example, a pizza has 6 slices. So it's the portion of the slice that the person, the owner have, the ownership that they have in the company. Moving further, so how we evaluate the value of the stock? So the value of the stock is being valued by different factors. Okay, there are some common stocks, there are preferred stocks. So for example, we already have studied about it, that how companies raise money by equity shares and preferred shares. Similarly, common shares and preferred shares. So common shares, common stock uh, has the power to vote, but they are not limited to the payment of fixed dividends. However, on the other hand side, preferred stocks have the obligation to be paid at a certain amount of dividend, which is fixed, which is a fixed rate. So what is a stock valuation? So stock valuation is a very important concept which helps us to make informed decisions. So whenever investors have to invest money in any business or any company, they measure the value of the stock, that what is the value of the stock that the company we are going to invest in the market. So it's one is market value. So at present what is the value is called market value. However, for example, the house that you have bought 10 years ago have different value at that time, and that house has different value at this present time. So present value is different and the future value would be different as well, right? So fair market value of a financial instrument is very important to evaluate it, because in terms of when the investors have to sell their stock and when they have to purchase the stock, they made this valuation. So there are two categories in which we value stock. One is called absolute valuation and another one is called relative valuation. So absolute valuation values the internal value of the company. Okay, what are their cash flow, how they pay dividends, how their growth grows. Okay, so there are different kind of models through which we can evaluate that what is the financial strength of a company, what is the financial health of the company, internal financial health, I mean the intrinsic factor. Okay, so dividend growth model tells us, assesses the capability of the company to pay the dividends to its shareholders. According to this method, the dividend is the representation of actual cash flow of the company. It shows the true value of the company's share. So this is one of the valuation model that we use. However, comparable method in comparable method we have some benchmark value where we evaluate the stock of the particular company. Another one is methods used under relative valuation. So in relative valuation method, what we do, we evaluate the company's financial health, the company's position in the market by using different kind of ratios. For example, what is the price per earning? How is the earnings per share? What is the growth rate? What is the liquidity ratio? How much assets do the company have to pay the short-term liabilities? What is the company's profits? So what are the retained earnings? How much money has been left out in the company after paying all the obligations? Okay, so what is the enterprise value? What is market capitalization? So all these ratios we are going to study in the coming module. So these are the ratios that we are going to study, but this is the relative variation of the company. So common stock valuation. So common stock is a share and is more difficult to value in price than a bond of at least 3 years. Why? Because common stock common stock not even it does not promise to provide definite dividends to the shareholders. Okay, and the holder of the common share is not obligated to have the power or to have the ownership over the assets of the company in terms of bankruptcy. Okay, so it would depend upon the decision of the directors of the board, that what they have set up in the terms and conditions, but there is no obligation. The life of investment is forever. So common stock have no maturity. So we cannot measure the rate of return in this case. So that's why its valuation is difficult. So for example, here you can see how can we value the common stock. So imagine you are considering buying a share of stock today. You plan to sell the stock in 1 year. So you somehow know that the stock will be worth $70 at that time. Okay, so in the coming times, you somehow know that in the future it would be $70. Okay, the value of the one stock. You predict that the stock will also pay $10 per share dividend at the end of the year. So you want to keep that for 1 year. Okay, so if you require 25% return on your investment, what would you pay for the stock? It is the present value that we are going to calculate for the stock that we will pay today in order to get $70 in the future with $10 payment as a dividend. Okay, so in other words, what is the present value of $10 divided along with 70 ending value at present 25%. Okay, so what we will do is we will use this formula and we will calculate it. So that would be 64. So $64 is the value that we would assign today to the stock in order to get $70 at the end of the year with $10 per share dividend. So in this way, we can calculate the value. Another special cases of the common stock valuation. So the dividend has zero growth rate. The dividend grows at a constant rate. So there are two kinds of dividends also. Okay, so next is time value. So time value has a very important concern. What is time value? Time has a value which is associated with it, and in financial analysis and in finance, time plays a very important role. For example, the house that you have bought 10 years ago has different value, has different valuation 10 years after or today, right? So in this way, if you would prefer to receive $1 today rather than in 5 years time, you recognize that there is a value of time which is associated with money, right? So money received now can be invested to earn additional cash in the future, so an interest can be earned. So the money that we invest today, we can earn interest over that, right? So also you keep the opportunity cost, so better investment or opportunities to consumption may be available. So as I have given you example of the home or the house that you bought 10 years ago, it has a different value today and 10 years ago, and would be 10 years after it would have the different value, right? So these are the conditions. So it means that time value is associated with the money. So time value relationships, how we evaluate the time value related with the finances. So first of all, time. How long I will postpone, delay, or invest in a given investment. Number two, cash flow. How much, how many times I have to pay for the installments, or how many times I would get paid in terms of interest rates. What would be the interest rate according to the market, according to the stock that I am investing in? Okay. So timelines. Next concept is about timelines. So timeline is a graphical representation which shows you that how much amount of stream of cash flows would be with respect to the interest rate, how it would flow today and in the coming times. Okay. So whatever cash comes into the company is inflow, and it is always positive, and the cash which goes out of the company is called outflow and is always negative. So in this example, you can see the timeline and the importance of the timeline. So if you can see here that if you want to lend at no interest 1000 euros to your friend, and you agree half will be repaid in 6 months, so and the rest 6 months after, so how it would be? So total 12 months, right? And so you gave money, so it's a negative cash flow. So y minus 1000, half would be repaid after 6 months and half would be paid re-up. So from your point of view, the first cash flow is an outflow, right? So it is a negative as you give the liquidity away to your friend. And the next two cash flows would be the inflows, from because from your point of view at the point zero, you see that the money is coming to you after 6 months, right? So now how to construct a timeline. So timeline represents the present value and the future value. So you have to pay the rent of 5,000 euros per year for the next 3 years. You will be in Barcelona. So in your rental payment will be equal and will be paid to be at the start of each semester. So you have to pay the rent every start of every semester. Okay, so draw a graph of the rental payment. So here you can see how would you pay. So 3 years, 3 years means 1 year, 2 year, and 3 years. 36 months, right? 36 months would be there in 3 months. So in the end, you have to pay, for example, if we go back to the statement. Okay, so for example, here if you can see that in 3 months, you are going every year you are going to pay 5,000 euros, and you have to pay in advance of every semester. So from here you can see that minus 2,500 you are paying at the start of every semester. So you are paying, that's why it's a negative cash flow. Okay. So next topic that we are going to study is about simple interest. So simple interest is an interest which incurred for a definite period of time. So for example, if we have to find out the future value, so how could we find out the future value of any financial transaction? So we will calculate by using this formula where PV represents the present value, and if we want to find out the present value of any amount of the money, so we can calculate by using this. So for example, here you can see interest to be paid on an investment of $1,000 on earning 5% interest over 2 years period of time. What would be the future value? How much would you get paid in the future if you invest $1,000 at 5% interest rate in 2 years? So we can calculate it that in order, if we invest $1,000 today, we will get into years of over 5% interest rate paid, then we would receive $100 with profit. Okay, more. So if we are promised an amount of $1,100, which we has earned 5% over the period of 2 years, how much we have invested? So if we use the formula of present value, we can find it out, 1,000. Okay. Another very important aspect is capital budgeting. So capital budgeting is very essential and is very interesting topic, which gives us the introduction about whether the projects that we are incurring or which we are going to incorporate with is worthy or not, whether we should invest in that project or not. So capital budgeting is used to value the potential projects. It helps us to take long-term decisions. It helps us to plan our large expenditures, that where should the company invest. However, if we have long-term obligations to be paid, then how would we manage it? So it gives us a flexibility to make financial decision for the firm. It helps us to make strategic decisions as well, because it gives us the guidance over how to use our resources and where they are needed. So in capital budgeting, we measure two types of things. One is called net present value and another is called internal rate of return. So net present value of any project is calculated by using this formula. So cash flow, CF represents the cash flow, where CF note is an outflow, is an initial cost that you incur in any project. Okay, so that is minus, that get minus from all the cash flows that the project brings in the company. So if the net present value is greater than 0, it means you are getting some profit out of the project. So it's a positive net value for the project. Okay, so you will accept the project because it is adding value to the firm. However, on the other hand side, if net present value is less than 0, then it means that the project is bringing nothing to the firm. So it does not deliver a positive net return for the investment that the company is going to do. So you will reject that project. However, if net present value is equals to 0, it means that the project would repay the invested capital, but it would not bring the required return in the company. So here is one example over the net present value. You can see if you are a chief financial officer of a corporation in Europe and your sales department proposes you to invest in a new project. So you know that the investment, the return that for any investment is 5%. Would you consider approving the investment in that project? For example, time is 3 years and you have to invest 100,000 euros, and in the next years the project will return every year 40,000 euros. So 40,000, 40,000, it means in total it would be how much euros? 120,000 euros you will get, right? So now you will see here, when we solve it, that initial investment was $100, and every year it would pay $40,000 over the rate of 5% return. So the net present value is large, is positive. It means that the project will bring the internal rate of return, which is 9.7% impact. So that's why it would bring uh, added value to the corporation. So it would add to the wealth of the corporation. So you would approve, as a project manager, you would approve it. Okay, some of the features of the common and the preferred stock. So we already discussed a lot of features about common and preferred stocks in the last webinar. What are common stocks and what are preferred stocks? So common stocks have something which is special with it, is that they have a power to vote. One share is equals to one vote. However, they have no special preference in case of receiving the dividends and bankruptcy. So common stockholder owners have the proxy voting, that they can assign other one on the behalf of them to vote. They have the right to take management decision. They have right to transfer their right to vote to another party. So they can bring as many proxies as they can. But sometimes if the shareholders bring too many outside proxies into the company, then it leads to the proxy fight. So what is a proxy fight? So when a group of shareholders join and gather enough shareholders in order to win a corporate vote, this is called proxy battle. Because if so many proxies comes into the company in order to take the decisions, then it could lead to the takeovers. So this is something conflict creating in the company. Okay, so there are two different classes of the common stock. However, there are some other features which are related with the common stock, that the vote on a stockholder matters of great importance, such as mergers. However, they have an opportunity to um, to proportionally getting paid dividends. So it would depend how the rules have been set up. However, on the other hand side, they have preemptive right, which means that the company that wishes to sell stock first offer it to the common stockholders before they offer to the general public. So this is called preemptive right. Moving further, payments by the corporation to shareholders in cash or stock is called dividend. So it represents the return on capital, that the dividends are being paid to the shareholders. It is a discretion of the board of directors, okay, that whether the dividends are going to be paid to the common stockholders or not. So it is not a liability of the corporation to pay dividends to the common stockholders. So corporation cannot default on an undeclared dividend. Corporations cannot become bankrupt because of non-payment of the dividends. And in case of bankruptcy, the company have no liability to pay back the dividends to, the authority of assets of the common stockholders. Okay. Another one is preferred stock. Preferred stock over common stock is the features that differentiate them from common stock is that the payment of dividends, that the dividends get paid in preferred stocks. So they have preference in the distribution of corporate assets in the event of liquidation. Holders of preferred stock sometimes have no voting privileges, so which makes it different from other ones. Okay, so preferred stock is a class of ownership in a corporation that has higher claim over assets and earnings. So in case of bankruptcy or something like liquidation happens in the company, so the owners of preferred stock have the privilege of getting paid. They get paid with a fixed dividend. So they As an equity, it has potential to appreciate in price even. So moving further, if we say, is preferred stock really a debt? So it's a debt that the company have to pay dividend every time. So they receive a stated dividend. If the corporation is liquidated, they get stated value. If they carry credit ratings as bonds, they are convertible as well into common stock. So corporation is obligated towards the preferred stock. So can we call it like a debt? Seems to be a lot like a debt, but for tax purposes. Okay. So last but not the least, the topic that we are going to discuss is about stock markets. So what is a stock market? A stock market is a market where we trade and sell, where we buy and sell the shares. So there are two types of stock markets, primary market and secondary market. So primary market is a market where the shares are being bought and sold to investors, and in the secondary market the trade is being held between the investors. So a dealer is the agent who deals in the buying and selling of the shares from inventory to the investors, and the dealings that are being done between the two investors in the secondary market is called broker. So dealer belongs to the primary market and broker belongs to the secondary market. So here you can see the advantages of a corporation or of a corporate firm is that they have, first of all, they have financial status, they have legal status, money can be raised more easily because they have more trade confidence, right? So here you can see the picture of a financial market, that how financial market comprises of both investors and borrowers. So financial market consists of banks and other financial institutions. So they need both. They need investors who lend money to them, and they need borrowers whom they lend the money, for example, companies and governments. So how this whole financial market and corporation thing works. So if you see here, the picture shows the interplay of a corporation and the financial market. So let's talk about it. First of all, if you go to the point a firm issues security to raise cash. Okay, so this is a financial market. Okay, total value of the firm to investors in the financial market. So this is a financial market which issues short-term debt, long-term debt, and equity shares. So what happens is that firms issue securities. So the firm's total value of firm's asset, firm invest in assets like current assets, fixed assets, after after buying or selling the securities, right? So they invest in the assets, fixed assets or current assets. So what happens? So cash flows are generated over these assets, right, during their day-to-day activities. So they earn some profits. So they pay that whatever amount of cash flow is generated, they pay to the government in the form of taxes, and they pay back to the stakeholders as well. And whatever money is left, they reinvest in the company. So in this way, how the cash flow is paid out to the investors in the form of interest and dividends. So in this way, the whole financial market and the corporation works and how they interplay. So cash flow to and from the firm. So where this whole process of financial transaction happens is called a financial market, as we have seen the interplay which is being done. So primary market versus secondary market, we already have discussed about it, and you can see here as well that the if any corporation issues shares, so company sells to the investors, this is a primary market. But when investor sells to the investor is called secondary market. Okay, so here comes the last topic of this module, which is called circular flow model. In the circular flow model, what we study about the economic model, that how the money, how the goods, and how the services are being moved into an economic system. It helps us to calculate the GDP of a nation. What is the national income of the company, how it is being formed, that we can easily calculate from it. So this model is called circular flow of money or capital markets. So this is the model that you see here. So this goes between two cycles. Okay, so observe this cycle very carefully. If you see that it's a light blue and it's a dark blue, so how it works like that the businesses offer goods and services to the households. Okay, and households pay for those goods and services. They do their expenditures which come back to the businesses. Another example is that the household, the labor comes out of them, they work for the businesses and the businesses pays the personal income in terms of wages and dividends if the factors for production have invested in the company, then they pay the dividends. So in this way this cycle works. However, in the five flow model, there is household, there is business, and there is government sector as well, and the financial sector and the foreign sector. So in that the government is responsible for the taxes, the foreign sector is responsible for the foreign trade. So this is a link where you can go and you can watch that how circular flow of model works, and you can learn more about the five flow model as well. Okay, so the last topic is about listing. What is a listing? Listing, when we say the company is listed on a stock exchange, so it is a list of the company, which is an organized exchange legally, in which the companies are listed in order to do the trade. For example, it is being listed by meeting certain criteria of some asset size, number of shareholders. In order to be listed on a stock exchange, you have to comply with some criteria, definitely. So, okay, thank you so much. I hope you have liked my presentation and you got the insights of the financial world in a better and in an easy way. That is my approach, that I have to bring on the table the easiest possible knowledge of finance and making this subject more easy and easy approach towards my students. So thank you so much from your professor, Professor Harsirat Kaur, and hope to see you in the next class. Take care. Bye bye. See you in the next class. Have a nice week. Bye.